The most dangerous trade in the world, shorting volatility. In the next few minutes we will discuss the dangers of shorting volatility, a trade that has caused significant losses for many individuals and hedge funds. Despite its risks, more and more people are getting involved in this trade. We will explain how this trade works, why it is destined to destroy those who engage in it, and provide alternative strategies to protect your portfolio. Understanding volatility. Volatility refers to the degree of fluctuation in the price of an asset. It is often used as a measure of risk, with higher volatility indicating higher risk. In the financial markets, volatility is commonly measured using the Volatility Index, VIX, which reflects the volatility of the S&P 500. The VIX is calculated based on the pricing of at-the-money options on the S&P 500. When the pricing of these options is higher than usual, it indicates an expectation of increased volatility in the market. Shorting volatility. Shorting volatility involves betting that the volatility of the market will decrease. There are various ways to engage in this trade, including trading options on the volatility index itself, or using exchange-traded funds, ETFs, that track the inverse of the VIX. One popular ETF for shorting volatility is SVXY, which uses futures contracts to track the inverse of the VIX. When volatility decreases, SVXY tends to perform well. Why volatility is historically low? Currently, volatility is at historically low levels. Many investors are betting on this trend to continue, leading to an increase in shorting volatility. However, history has shown that volatility tends to spike during periods of tightening monetary policy. When interest rates rise and market conditions become more challenging, volatility increases. Therefore, it is only a matter of time before we see another spike in volatility. The dangers of shorting volatility. Shorting volatility can be a dangerous trade. When volatility spikes, all the traders who have shorted volatility need to close out their positions. This creates a domino effect as the increased trading activity adds to the pressure and further increases volatility. This sudden unwind of the short volatility trade can result in significant losses for those involved. ETFs like SVXY and UVXY, which track volatility, are particularly vulnerable to these spikes and can experience substantial drawdowns. Alternative strategies. Instead of engaging in the risky trade of shorting volatility, there are 3 alternative strategies you can consider. First, buy out of the money calls on the VIX. When volatility is historically low, you can purchase options on the VIX that will benefit from a potential spike in volatility. This strategy limits your risk, as you can only lose what you spent on the options. Second, hedge your equities. During periods of expected volatility spikes, you can hedge your equity positions by purchasing put options on the VIX. This way, if the short volatility trade unwinds and volatility increases, your portfolio will be protected from significant losses. Third, learn and educate yourself. To navigate the complexities of the financial markets and protect your portfolio, it is essential to educate yourself. Become a subscriber of our YouTube channel, All Things Money, where you can learn about various strategies to protect against blow-up risks, make consistent profits, and expose yourself to asymmetric upside opportunities. Conclusion. Shorting volatility is a dangerous trade that has caused significant losses for many individuals and hedge funds. While it may seem tempting to engage in this trade during periods of low volatility, history has shown that volatility spikes are inevitable. Instead of risking your portfolio with short volatility strategies, consider alternative strategies such as buying options on the VIX or hedging your equities. By educating yourself and learning from reputable sources, you can protect your portfolio and make informed investment decisions. As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.